Hello and welcome back to Dukascopy TV. Today I'm joined in the studio by Coast Sullenger, Managing Director of GAIA Capital Advisors, and today we're talking soft commodities and prices. Coast, thank you so much for joining me today.
Pleasure.
Now, talking on soft commodities, we've seen quite a rise in the price of soft commodities this year. What do you see going forward now into 2013?
Yeah, well, that's a good question. I mean, basically, this year we saw a big spike up in prices. If you look at the various indices, for example, the FAO Food Index, we've actually come back to the level where we were in 2008. So we are looking at historical levels, and that was mostly driven by weather issues. So we had drought in various main, let's say, crop-producing regions. We had problems with too much rain in other regions. So it was really a bad year for weather all around, and that caused a shortfall in production. But going forward, I would more expect, actually in the short term, I would more expect that the prices will stabilize and prices might come down a bit because this was a really abnormal year in terms of weather. But I think we have to not lose sight of the, let's say, structural drivers that have been pushing grain prices up over the last 10 years, and that is the big acceleration of consumption on the back of a production which is not able to keep pace with this consumption growth. And the consumption growth, we're all familiar with the reasons behind that. It has to do with population growth. We hit 7 billion population on the planet in 2011. In the next 50 or 60 years, we're going to 10 billion according to most estimates. So that's clear. But moreover, it has to do with the income, let's say, income growth in emerging markets, which is driving the the richer diets, the higher protein diets, and that's translating into big demands for grains. And so what we've seen is that the inventory level, as measured by the, let's say we call it the stocks to use ratio, which is the inventories expressed in a days of consumption or percentage of total consumption, this level has been driven down to a historical low, actually. Corn was already very, very tight last year. It was at a historical low, and now wheat, because of what happened this year, has also been driven to a 30-year low stocks to use ratio, which used to be around 90-something days, and now we're around 72 days, it looks like. And you know, you could think of that as being that the population of the planet is 72 days away from starvation somehow, which is true because, you know, if we don't reproduce and we eat our way through those reserves, you know, we have 72 days. But that's a little bit, that's a little bit theoretical, but it is a worrying situation, and that's what's been driving the prices up.
Can we just talk about agriculture? How is agriculture looking as an investment? Is it still an attractive form of investment? Yeah.
Well, to me, agriculture as an investment is really in its early stages. It's still very early days. I mean, agriculture as an investment was unheard of, you know, before the 2006, 2007, when the prices of soft commodities started running up. And I still think that the bulk of the agricultural investment goes into the physicals and the futures market, which is the most liquid, but albeit the most volatile. And it's been the big performer of last year. We'll give it that. But I think that there is a growing risk in that space, and that is a regulatory risk, which is driven by the, let's say, negative humanitarian impact that is potentially driven by the investment and the speculation on underlying grains.
I've seen, is investing in agriculture the same as investing in farming? Is there a big difference there?
Well, most investments in agricultural equities are going into the chemical and fertilizer sector, which is the largest, let's say, in terms of the overall capitalization of the sector, it's the largest, let's say, block. And some of the big indices which are on the market, such as the MU index, it's more than, I believe, 60 or 70% represented by chemical companies. So the attractive thing in our mind about farming, and the reason that it's a major focus of our activity, is that farming represents about 23% of the economic output of the agricultural sector, but it's less than 3% of the market capitalization. So it's heavily undercapitalized for a number of reasons. But as such, farming is actually, when you invest in a listed farming company, you get exposure as an investor to underlying land, which is a tangible asset. You get exposure to all sorts of crops. You get exposure to growth because those farming companies are very often having a very strong organic growth. And today, again, it's ironic that those companies, despite having the tangible assets, and not having much debt and being very attractive cash generative businesses with vertical integration, they are trading around 30% discount to their NAV, to their book value. So I think that's a real mispricing that I can only imagine is driven by the overall weak sentiment in the equity markets.
I see. Yeah. Well, Coast, thank you so much for coming in and talking to us about this today. Just lastly, we're going to go on to the Dukascopy question. So we ask every guest that comes into the studio, if you had $1 million to invest in the market for just 1 year, where would you put it and why? I know we've been talking about soft commodities today, but let's have a look at your options here.
Aha. Right. Well, I would say between those options, I certainly wouldn't touch cash and bonds because I think we're at the top there. I really do believe that cash's currencies are going to be debased in a number of dollar, euro, and all currencies with weak fundamentals. I would focus more on gold, for example. I don't expect a big run up, and we're active in that space. I don't expect a big run up in the underlying gold price, but I think gold equities are quite attractive because gold equities, very similar to agricultural equities, they're very depressed on their historical valuation versus the underlying. So we have a historically wide spread between the valuations of gold and gold equities. So I would pick gold equities. I'd go long gold equities.
Thank you so much, Coast, for coming in and sharing your insights with us today.
Pleasure. Thank you. It's a pleasure to be here.
That's all from us here in the Dukascopy studio. Just remember that you can join in with any of our live daily webinars by going to the Dukascopy website.